All right, guys, what's up? Jim and Caleb here. Another Doors to Deals episode. We have Nick Legamaro on the line. Excited to have you. This has been a journey. We've been had them on schedule, then it got canceled. Then I had to move it. I had things come up, and lo and behold, almost a year after I met you and Caleb met you,
Almost to the day, literally, like
almost to the
within a
day,
week.
yeah. And we're gonna hang out at a investment event next week, so we get to see each other in like twice in 2 weeks,
I
even though
know.
it's been a year.
Go
So
figure, right?
yeah, go figure. So Nick, what's up, man? How about you kind of give the audience a little bit of a background and so we can get this thing started.
Hey, well, thanks for having me, guys. Hey, yeah, excited to be here. Yeah, just a little bit about me. I've been around in real estate since 2001. Man, I always joke about I was around in 2008, survived the crash, and lived to talk about it because it's funny because when I go to speak and I'm in an event, I was just in an event in Phoenix, like a couple 300 people, and I asked the question, how many people were around before in when the market crashed in 2008? And out of the 300 people, I maybe get 8 that raise their hands. They just weren't around. So guess what? We're in the middle right now. We're getting into a very similar situation that a lot of people aren't really going to know how to respond to, right? But I will tell you this is a huge opportunity. I've literally, no joke, been waiting almost 10 years for the economy to be where it is right now relative to real estate. It's the perfect storm for a lot of different reasons. I'm sure we'll talk about that as we go on. But at the end of the day, we're really, when I got started, we didn't have what we're doing right now. We didn't have YouTube or meetups or even data readily available like we have today. So the advantage that your audience has is getting to hear and see people like us speak about this stuff that really educate themselves and expedite their learning curve. Because if I had what I had now when I was 20, 25, 30 years old, I can promise you I would not be sitting here talking about it because I wouldn't have internet connectivity on whatever island that I would be sitting on right now. But my loss is everybody else's gain, as I say. So
yeah,
we're good.
it's that's totally, yeah. I mean, that is spot on. I mean, I remember Ryan and I dropped $20,000 on a coaching program that honestly is on YouTube now. Like everything that was in there it wasn't anything different than what you can find on YouTube now. Yeah, so that's fascinating. Absolutely. So so Nick, tell us about like your background, kind of like what leading up to real estate, why you got into real estate. And
so I started early on, and then when I did everything what I would say the wrong way back in the early days because we didn't know what we didn't know. We didn't have it. There was a couple courses you could buy on real estate. I think Ron LeGrand had one. I think Carlton Sheets had something, but I got out of real estate from I was fortunate enough to get out fairly unscathed. Okay. Now the conditions today are much different than they were back in 2008. Okay. But I got back into real estate in 2010 and I didn't know what I was going to do, but there was a lot more information that was available. But I knew right away that the way to generate wealth was in real estate. That's where millionaires are made. Millionaires are created and made through real estate. They're not created from working a 9 to 5.
So Nick, if you don't mind, if we can slow down just a little bit, because like I got started in 2008. So like shit had already hit the fan.
Right.
And I cut my teeth in a very difficult market. So like I know how to thrive and succeed when the market's shitty, so to speak. But I wasn't investing before that turn happened, right? So tell me a little bit about before the turn happened, like what your business was like, and then
so the business that back then you could do a lot of things different. Like for example, a big strategy back before was short sales, right? Most people don't even know what a short sale is, right? We may see some short sales moving forward, but for the better part of the last 10 years, short sales were fairly non-existent, right? There was no reason to short sale. A short sale is basically getting bank approval to sell a house for less than what you owe. Okay. Well, you could have been the worst at whatever it is that you were doing and had your property appreciate in value over 3 months just while you're waiting to make a decision what you're going to do. So values have gone up. Well, values go up, balances don't go up. They stay relatively flat or decline. So that's part of what we used to do. But back then I used to do fix and flips and sell them to investors. I wasn't even an investor. I was more of a transactional guy, right? So I'd buy a property, I'd fix it, and I would sell it to an investor, and they would turn it into a rental property. That's what I did. I did a lot of those, many of those, 100% transactional with no cash flow tied to it whatsoever, which is 180 degrees different than what I do today.
So I love that, and we've talked about this before too. Like the fix and flip, that's a job, guys. Investing is building a portfolio. It's building passive income so that you can get out of the rat race. You can be a very successful doctor and make a lot of money. You can be a very successful YouTuber or whatever. All those are jobs that you in order to get financially free, you have to then take that money and put it into an investment and be an investor, right? So I love that you mentioned that. I couldn't.
Well, and that's what we focus on now. To be quite honest with you, we show, because there's like, who is this for? Like what we're going to talk about today. I break it down in a couple different categories. There's wholesalers, right? We know what let's just talk about wholesaling, because maybe people don't know what wholesaling is. Basically, wholesaling is a version of a realtor, right? Like they go negotiate directly with the seller, and they add a fee, and then they sell it to more than likely an investor for profit. It's a transactional model. That's one. It's a job, right? It's a good job and it's scalable, and you can make a lot of money on it. But nevertheless, if you stop wholesaling, you don't have any more income coming in. Same thing with fixing and flipping, right? Fixing and flipping is another strategy where you buy it, you fix it, sell it for a profit, but then once you're done with it, you get a big fat stack of cash, and you got to do it again if you want to make more money. So what's cool about what we've done is, and we'll talk about this, is how do you take a wholesaling model or a fix and flip model, for example, and turn it into cash flow, right? How do you turn it into a cash flow versus a transactional model? And we can maybe talk about that as we go along, because that's exactly what we've done. And that's exactly what I do. All the transactions I do, even if it's a fix and flip or even if it's a wholesale deal, the end game is always to generate cash flow. And the way we generate cash flow is creating mortgage notes and being the bank. Okay. A lot of people think the only way you can generate cash flow is by buying and holding a property. It's just not the case, right? Most people think the only way you can generate monthly recurring revenue is by owning a property and renting it. Well, that's just not true, because what do banks do, right? Banks control everything and own nothing, right? Let's think about that for a second. They control everything but own nothing. Banks do not own real estate in the sense of what we're talking about here. They don't own the house. They'll lend you money to go buy a house, but guess what you do? You pay them, and that's how they generate cash flow as far as that goes.
The banks make the most money in the real estate world out of everyone.
There's a reason why you go into every major city, even small cities. Go into downtown St. Louis, go into downtown Phoenix, Atlanta, Boston. I don't care. Pick a city. Go downtown, look straight up in the air, and tell me what the top of those buildings. They have the names of banks almost exclusively. They don't say Keller Williams. They don't say Remax. They don't say whatever the hedge fund is. Okay. They say the name of the bank, because banks learned a long time ago they can control and not own and make a crap ton of money doing it. So what we want to do is be the bank, right? We want to think, act, and be a bank. And that's what hopefully we can spend a little time talking about today, and how you can do it, because most people do not even know they can be a bank, first of all. Okay. So we might want to talk a little bit about that. But once you understand the concept of being what I call a lien lord instead of a landlord, it's a game changer. I always joke to my friends that are landlords, and I go, well, you're only a landlord because you haven't figured out how to be a bank yet. Now, that's not really true, because there is benefit of being a landlord and owning property. I have a lot of friends that own a crap ton of properties, and that's cool. But you need to understand the differences in the time and place, and when the opportunity presents itself to maybe be a bank when being a landlord doesn't make sense. Okay, because you wouldn't want to necessarily be a landlord on a house in the middle of Ohio that's worth $42,000, and you're dealing with a $500 a month rental payment. Okay, however, you might not have a problem being the bank in that location because you don't own the property. You're just being the bank. So it's really a personal preference a lot of times. But what I like to do when we're the bank, we have the ability to generate the cash flow without incurring any of the risk and paying off debt and staying in the deal with infinite ROI.
You had said something earlier about like a perfect storm of the economy in the real estate market, and that kind of like, it's someone, I've been in real estate since about 2013, and I'm very educated on what happened in 08. What do you mean by right now is a perfect storm?
Well, let's talk about a couple things real quick. First, let's talk about the seller financing industry in general, okay? Because this is all about seller financing, okay? And what I mean by that is, let's talk about how big the seller carry market is. And seller financing, all that is the amount of mortgages that are created and offered to buyers that aren't named Wells Fargo, Chase, or Bank of America. Okay, that would be a traditional lender. So we have an opportunity to be non-traditional lenders to buyers that need financing that can't go down to the bank. For example, right now, depending on where you get your information from, it's anywhere between 60 and 70% of the population that wants to buy a house cannot walk into a bank and qualify for a loan. Okay, think about that for a second. 60 to 70% of the marketplace cannot go get a loan. Has anybody talked about this or heard about this in the last 5-10 years? Never. They only talk about what rates were, what they are now, and how hard it is to buy a house. Well, that's sort of true to a certain extent, but what we don't hear in that conversation is that almost 25% of all the properties that have been purchased weren't bought by individuals. They were bought by funds and private equity groups, stuff like that. So it's really the data is accurate, but understanding what generates it or what drives it is something else. So let's talk about the other side of it, because it's economics 101. Okay, if 60 to 70% can't qualify because the banks have told them no. For example, I cannot get a traditional bank loan. Okay, if I want to go buy a $200,000 house and I want to get a bank mortgage on it, and I have $2 million in the bank and I could buy that house 10 times over, I cannot get a traditional bank loan because I have multiple companies. I get paid dividends. I don't have a W-2 job. They don't like that stuff. They want the buyer to be a pretty buyer that fits in a very specific box. And when you don't fit in that box, you don't qualify. So what happened in COVID, right? Same thing. People had to change their jobs. People have multiple jobs now. People are self-employed now. That all affects the ability to go get a traditional bank loan. That's number one. Number two, on the inventory side, let's talk about that for a second. If you go on Zillow or Realtor.com or something, and you go do a search and pick a city or a county, and you see how many properties are available. Let's just say Phoenix, Arizona. If I go in Zillow and I look at all the properties that are for sale in Phoenix, Arizona, the number might come out to be 5,000. Okay. Then I go adjust the search and I put properties that are available for sale with owner financing or seller financing, owner carry. The number of properties that will be available to purchase on terms or seller financing will be less than 5%. I've not seen a market anywhere in the United States in the last 10 years where seller financing is available at a greater than 5% mark. So let's think about this for a second. If less than 5% of the properties are available with seller financing, but 70% of the marketplace needs seller financing, it seems like that's a pretty good situation to be in if you can figure out how to creatively structure deals. Would you agree?
Yeah, absolutely.
Exactly. So the best part about this, when we talk about rates going up, as rates go up, the seller finance buyers are not affected by this. And the reason is they were never going to go get a bank loan at Chase or Bank of America for 3 or 4 or 5% anyway, because they couldn't qualify. So the only way they could get a loan was by somebody that was going to provide seller financing. So as rates continue to go up, that just fuels the fire for a bigger need and demand for seller financing.
Gotcha.
Any questions on that before we?
No, that makes perfect
move on?
sense. I wanted to get more clarification.
Let me tell you, I'm sort of a stat nerd. Okay. Let's talk about how big seller financing is. Okay. Right now, the seller finance carrying market, all the mortgages and stuff that are not named Wells Fargo, Chase, B of A lenders, it's a $27 billion industry. $27 billion industry. Okay. You can ask 100 people how big it is, and they may guess, but they will likely 99 of them will not know how big that industry is. Okay. I'm in the space. I know what it is because that's my job, but a lot of people that are educators and professionals that do hundreds and thousands of transactions, you don't understand that. That's a fairly big number. The other thing I will tell you about that number, that 95% of those mortgages are what I would call incorrectly written from a value standpoint. They're not illegally written. They're just not written with best business practices. So it impacts the value of the note, because if you're going to create a note, you want to create it that's going to give you the highest value in the event that you want to either sell it at some point in the future, sell a portion of it or whatnot. And that's what we can surely teach, because at the end of the day, there's really only 4 things that you need to be able to do. You need to be able to find a deal. You need to be able to analyze the deal. You need to be able to somehow fund the deal. And then you need to be able to find the buyer. So all the stuff we're talking about, it can all be done for you through servicing companies, through underwriters, through attorneys, title companies, things like that. So you don't need to know how to create the perfect note. It's already done for you. You just need to know where to go or who to ask to get it done for you.
So let's go into like a creative deal structuring. So you're at a home talking to a client and trying to propose like, hey, we can do this seller finance. Like walk us through how you like to structure that, what you recommend.
Yeah. So let's just look at it. So a typical negotiation with the seller, it probably is, some kind of dialogue back and forth, and you're trying to get to the point where you're going to make an offer to the seller to buy their house, right? And 98% of the time, it's a cash offer. So what happens when the seller says no to your cash offer? Let's just say, for sake of argument, let's just use round numbers. You offer $100,000. The seller wants 125, and they owe 115. Okay, well, you're never going to get that. You're probably never going to get that deal. But we can come in and with creative financing and structure, we can actually offer them more money than what they're asking, because we're going to get terms back in our favor. Now, I didn't say we're going to offer them more cash. I just said we're going to offer them more money. So we might give them some now and some later. If they own it free and clear, that's a different model than if they have an underlying mortgage, because I'm not going to talk and teach about sub 2, but you got to understand, in the last 10 years, the amount of mortgages that are out there on the street right now that are sub 4%, there are millions and millions and millions of mortgages. And those are the mortgages that you can have the opportunity to go structure with the seller. You can look, a seller might not want you to stay and take over that debt for long term, but we don't need them to. All we need to do is be able to do it long enough time to be able to create the back end, to create the note, to do what we need to do to exit out and be out of the deal completely. Because what we're going to do is we're going to create 2 mortgage notes. We're going to create a first and a second lien. Okay, so let's just use an example of this. And then how we acquire doesn't matter. For example, let's call it a $200,000 mortgage. Or we're going to sell the property for $200,000. We're going to get 10% down, which is pretty standard. So that's $20,000. We're going to write a first lien, let's say for $150,000. Remember, this is to our buyer that we're selling it to, and then we'll get into how we acquired it in a second. We're going to write $150,000 first. We're going to write a $30,000 second, and we're going to get $20,000 cash. Okay. Then we're going to be able to take that $150,000 first lien, and then we're going to either buy it or we're going to sell it. Right. We're going to get rid of it. We're going to take the proceeds from that transaction, and that's going to pay off the underlying debt. So let's just say that the seller owed $140,000 on it, and we were able to give him $10,000 cash, and he owed 140. We could create this transaction, and then when we get our back end buyer in place, we turn around and sell that $150,000 note. We pay off the $140,000 debt. The seller gets the cash, because what they're saying in the example here is that I'm not really looking for $150,000. I want $150,000 because I owe 140. I'm really asking for 10, right? So we can leverage that and work together with sellers to create these opportunities to exit out of these notes. Okay. So that's one thing. But a lot of times sellers also own these properties and they don't owe anything on it. Okay. Happens all the time. And it's like, well, if you'll take terms on this, then we can come in and offer them terms, pay them more money. Because we see this a lot of times with landlords. Okay. We have conversations with landlords that are tired of being a landlord, right? They don't want to be a landlord anymore. They're tired of dealing with the tenants and the toilets and all the trash. But they're sort of at a challenge of like, well, I like the cash flow though. Okay. Cash flow is nice. But here's the thing. Sellers want out. We can provide them we can provide them cash flow by letting them be the bank, being the bank to us as the buyer, for example. They get the cash flow. But here's the best part about it is that a lot of these properties have gone up tremendous in value since a landlord has bought them, right? It's not unrealistic for $150,000 acquisition 5 years ago to be worth $250 or $300 now, right? So the problem that an investor has or a landlord is that they have a huge capital gains taxable event on their hands, right? That's why a lot of times they don't want to sell. It's not that they don't want to, they want to sell, but they don't want to sell because they take that huge capital gains hit. Well, guess what? If you structure the deal to buy it from them on terms, on payments, they get the benefit of what's called an installment sale. Okay. I'm not going to get into IRS code. I'm not a financial advisor, an accountant, or attorney. You can seek that information out. But the benefit of it when they sell it to somebody on terms, they only are taking the tax on the event on what they collect. So if it's a $300,000 sale price and it's a 30-year term, for example, I'm just using round numbers here, the taxable event's basically $10,000 a year, not the difference in the capital gains that they would have seen. Got a lot of value.
I've ran numbers for a friend even on this, and the difference was $70,000 in capital gains if he sold a traditional way to, I think it was about $5,000 if he did seller financing on.
So if you're negotiating with the seller and you can get that to them, what can you do as a buyer? You can pay more, right? You can pay more because the seller is getting the benefit of it. So you can pay them a little more. And when you pay a little bit more, guess what you do? You wipe out your competition because now you're getting deal flow when they can't. Because if a seller's going to give me terms and I get that on my side, we will absolutely crush it on the back end on the structuring of the deal.
Oh, yeah. And then you think about it too, guys, like if your competition's, I mean, what are interest rates now? Are they 6 now? I should
7. Over 7.
All right. So let's say 7%. And the homeowner has a loan on a property for 3%, like you could pay 20, 30, 40, $50,000 more than the next guy. If, all things else being equal, if you're wanting to hold on to it for a while as a rental property, because your cost of money is half what the other guy's is. So over the course of time, you're going to make way more money on it because you're creative and you created a less of an expense with this thing. And
I think the biggest thing to understand, the one thing I would tell people to do as an assignment to go do is you have to go.
Hey guys, for those of you that are local to St. Louis, I wanted to make sure you knew about an amazing resource that we have to help do some extra deals. You can email our team at deals@3doors.com. And just so you know, we do deals with other investors all the time. Like it's been hundreds and hundreds over the years. And we've averaged over 100 deals with other investors per year over the last 5 years. We can straight up buy the deal if you're looking for, if you have a wholesale under contract that you want to sell. If you need funding to finance a flip, or like you're doing a burst strategy, we have funding available for you. If you're trying to wholesale a deal, we're doing JV wholesale deals with other wholesalers that, quite frankly, some of the deals we're putting together for a beginner or an intermediate investor, they'd probably be walking away from, because we have systems and processes and we have buyers in place that are paying top dollar for these properties. So make sure you use this resource. And the best way to get and the easiest way is to just send us an email, deals@3doors.com. All right, back to the episode. And
I think the biggest thing to understand, the one thing I would tell people to do as an assignment to go do, is you have to go learn and understand amortization. Okay. A lot of people think they know what amortization is, but they don't really understand how it works and why it works the way that it does. But once you understand that and you use that as your friend, excuse me, because payments don't change, right? When you lock into a 30-year term at an 8% rate or whatever it is, the payment is the payment. Even if you pay more money down towards the principal balance, the payment never changes. What changes, let's say on $1,000 payment, what changes is how much gets applied to principal, how much gets applied to interest on the borrower side. Well, it takes, depending on what the rate is, on a 30-year note, it takes about 23 years for that payment to be equal between the principal and the interest. Okay, so if it's $1,000 payment, you're not getting a $500 credit towards principal pay down until year 23. So let's talk about this for a second. This is really important. Not many people go 23 years on a mortgage. The average up until recently used to be about 7 years. Now with refinancing and remodeling, cheap interest rate, that's going to go a little bit longer. Let's call it 10 years. Okay. Well, if you run an amortization table on something for 10 years, let's just say it's $100,000 at 8%. I'm just wagging it. I don't have my financial calculator on, but I'm going to be pretty close on this. The unpaid balance after 10 years of payments on a $100,000 note is probably still $97,000. Okay. That's all they got $3,000 of principal pay down. Okay. That's why the banks have no problem lending money. Okay. Because guess what? They're getting all their interest now and you still own almost everything. It's craziness. Well, guess what? If you can be the bank and you can be in the position of holding that note, sounds like that's a pretty good game, if you ask me.
Yeah, what was that you said?
Every day that goes down, the money that you invested in it, the risk is mitigated because you're getting interest front loaded on the front side of it, and the balance is still there. So when they call the bank for a payoff in 10 years, who's the bank? You're the bank, right? Because you're holding the note. Yeah. And they're going to ask you for the unpaid balance. You're going to say $97,000. You get another big fat check for that amount at that point sometime in the future. That's the beauty of being a bank and the beauty of amortization.
On a $100,000 loan, it 8% interest. After 12 years, you've paid $100,000 in interest.
And what's the UPB on that? The unpaid balance.
So at year 10,
it's got to be 97,000, 96,000.
It's like 90.
No, is it that low?
Yeah.
Oh, because what was the interest rate?
8%.
Oh yeah, I was thinking more on a 9.5%, 10%. So that you would get a little bit more principal to pay down.
Caleb with his fact checking.
No, I wanted to say see how much interest. I didn't mean to fact check you. I wanted to
I was winging it. You're actually doing it, so that's good.
Well, yeah, but so here's the fascinating part with what banks do, though, guys, is like it is. My parents have been in their house for 40 years now. That's very rare. It's much more common for people to move every, it used to be 7 years. I think it's like 10 years now. But like the odds of so not only are they making all the money up front, they know that then they're going to turn around and give them a loan on a different house and then make all the money up front on that next loan too. So the majority of all the bank's money is it's in the first 5 to 10 years and it's all front loaded and they're making they're making out like bandits.
So back before 1990, okay, all loans that were written were almost exclusively assumable. They were assumable. You write a 30-year note, you sold the note and it would go with the house, and then you'd pick up and you negotiate and you pick up the balance and start making payments. Well, the banks got wise to that because they're going, well, I'm out of the deal. The banks are going, I'm out of the deal. So that's why they don't allow you to, in theory, assume a note. Now, buying it subject to is sort of the same thing, but what you're doing is breaking the way the note and the deed. But read the financial documents, and there again, I'm not going to give anybody advice or recommendations, but it does say in there almost every single mortgage that's ever been written, it says the bank has the right to call the note. Doesn't mean they're just say they're going to call it. Just says they have the right to call it. Nothing illegal about doing it. But there's other opportunities on the seller financing space. The reason why banks do that is because they want you, when I sell it to the next buyer, to go get a new loan. Because guess what happens? I pay down 10 years on my note. I sell you the property. Guess what you go do? Get another 30-year note.
And
now you got 10
and they're
for
back
me.
on day one. Yeah, that's right.
Goes back all the way back to day one. All that interest starts back over. So it's the gift that keeps on giving to the bank. They get 10 years from me. They get 10 years from you. They get 20 years from Caleb. They keep lending on the same asset over and over and over again. And all they do is get money on the front side. It's a crazy thing, but you know what? It's the way it works, man. And you need to understand how to be the bank. And that's why we teach it and do that. And hopefully, we can add some value. And if anybody wants to learn how to do that.
Have you ever seen a bank call a note?
Yes. But it's not because of the reason that you would think. It's because somebody that didn't do their job correctly when they created the paperwork. Usually it ties back to insurance, meaning they didn't correct the insurance. They didn't show the bank as the mortgagee, because they still are on thing. It usually happens at the insurance level the majority of the time.
Gotcha.
Now, if you got a small community bank and they got 100 notes on there and they have a department, they check that kind of stuff. Because what people think is that, why would the banks are going to go call all these 3% notes? They're making their money on the arbitrage already. They didn't borrow it. If they're charging you 3%, they were borrowing it probably negative or 0, right? They're already making their spread. So if they go, it's just shifting, right? If they're going to charge you 7 now, their cost of money is 4 or 3 or whatever it is. It's no longer 0, right? It shifts as well. So I don't. Well, you know what? Here's a fun activity to do. Call Wells Fargo sometime and ask them to speak to somebody in their due on sale department, and see what they say and where they send you to. Because there isn't one.
Yeah.
There isn't a due on sale department. It just doesn't exist. There's no, we don't even know what the hell you were talking about when you say that, even though that's what their mortgages have to say. But there again, we're not in it to stay in it. We're not using that as a way to arbitrage it long term. We're just using it as a vehicle to get us to where we want to go. So when we sell it, we can still get in and get out of it and get the deal done. Because at the end of the day, I'm not a big fan of risk. I'm not a big fan of arbitrage. I'm not a big fan of what we call hypothecation. Hypothecation is basically taking the note and leveraging it against to a bank and borrowing a part of it. I don't like any of that. I don't like leverage at all. A lot of people do, because here's the problem with leverage. I have a financial responsibility to somebody else. I'm just not a big fan of that. If I can create infinite ROI by having a free and clear asset, which in the form of the note, can I make more money? Yes, but I also have more risk, because what our model allows you to have infinite ROI. Think about that for a second. Do you want infinite ROI and get cash flow of $200 a month, let's say, for example, or do you want to have risk and make $300 a month and have an underlying debt that you're responsible for, or the potential of a due on sale, or the potential of a seller having an issue with what you've done, right? My position is, I rather deal with the $200 payment than the $300. I'll just go do more deals. That's the way I look at it, because now I have a big fat stack of notes that are performing that I have no liability on, no risk on. I can do whatever I want to do with it. And I don't have any liability responsibility to anybody because they're all free and clear. Because I sucked down the profit. I took it down to the profit level and paid off the debt by selling the note, basically the front half of the note in the form of a first, or what we could do is what we call partialing, which is selling payments. And basically you're almost like a factoring selling that. But this is what we show and we teach inside of our academy. And it's a great strategy, and we've been doing it for years. In fact, I didn't really talk about it. From 2010, when I got back into the business, I started a seller financing company with my partner at the time, John Montero, who's big in the multifamily space now, because after we sold the company, that was when multifamily was hot. I wasn't a big fan of multifamily. I stayed in single family and doing this. But we sold this company, this model, this strategy. We sold it to a federally chartered bank. We sold this whole thing that I'm talking about at a very high level to a 100-year-old federally chartered bank, because they cannot go do and create what we did, but they could surely buy the notes, because the notes that are created are extremely valuable because of amortization. Look at that. And you look at that, they get all their money up front, and they still have the asset as the security. Think about this for a second. Really, really important. If I'm selling a note, let's go back to that $150,000 note, for example. Okay. It's $150,000 for first. Let's say I sell it for $140,000 and somebody buys it. Okay. And they get a 10% return on their investment. But what else do they have? They have the house that's worth $200,000 as collateral in the event the buyer doesn't perform. That's a lot. That's super valuable, right? What's the risk to the note buyer that bought the note if they're in it for $140,000 and they're getting all that pay down on interest right off the bat? 98% of it goes to interest pay down, and they still have that asset as their collateral. They're in a really, really good position. The risk is mitigated. They got a really high return. That's why Fortune 500 companies hold notes in their portfolios. Family offices, hedge funds, private equity, banks, they all hold notes in their portfolios. The only difference is they go get them directly from, the warehouses and the big banks. They're all in the cahoots sort of together, because they can buy tranches of 10, 20, $50 million at one time. Where we can't create it that fast, right?
Yeah,
can't create it fast.
Yeah, and I can, and Caleb can personally attest for how valuable these strategies are. I mean, we're doing them at a very high level ourselves. We do, anytime we can do deals like this, we try and do them. Yeah, I mean, we're taking it to the next level. We're going to try and do this 600 times in the next couple of years.
Yeah. The biggest challenge, the biggest challenge when it comes to note value, okay? Whether you're staying in the deal, because here's the difference. When we create notes, individuals create notes, banks can create notes, and banks never die, right? Banks live on forever and ever and ever. Individuals, they have life events, right? They get sick, they need capital to go do something else. There's weddings, there's college graduation, there's cars. So as much as I would like to keep that cash flow coming in of $500 a month, at some point in the future, to most people that create notes, they rather have the lump sum payout at some point in time. The challenge is when you go to sell that note, just like you would sell a house or any other asset, when you don't create the paper correctly and you don't follow best business practices, you get hammered on the discount that you have to pay, because it's like this. I use my Ford F-150 because I'm in Texas. You have two Ford F-150 pickup trucks. They're both 2015 year models. They both have 50,000 miles on them. They're both white with tan interior. Okay. The difference is one's in pristine condition, has immaculate maintenance records. The other one is beat the crap. The windshield's broken. The interior's all trashed out. There's not a quarter panel or anything on the vehicle that isn't dented or broken, and there's no maintenance records. Which one of those identical 2015 Ford F-150 white pickup trucks is worth more money.
Yeah.
Notes are no different. Which one would you want to own if you needed reliable transportation moving forward? Right? Now, somebody might say, well, I'm a mechanic. I can fix it. So I'm okay buying it at a discount because I can just fix it and make it worth it. Well, that's great. But that's not what most people would do. A doctor in Los Angeles that wants to own a mortgage note in Atlanta, Georgia, doesn't have the time, ability, energy, or effort to try to fix that problem, right? Mm-hmm. So that's why we want to create the best things, because in the event that we want to sell it, we want to get max value. And by following this protocol and the process that we have, the average value of the notes that we see is 8 to 10% higher than the national average, because most of the national average is people that are writing notes incorrectly and they don't do the necessary things that they should be doing, such as underwriting the buyer or servicing the note or escrowing taxes and insurance, or putting other things in the file that need to be there that add to the pristineness, if you will, of the note. No different, because it's very hard to argue a brand new vehicle rolling off the showroom floor, right? You don't need to go inspect it because you know that it's already met the criteria. But when you don't do things right from the beginning, it makes it difficult for a note buyer to really assess value. So what do? They just say, well, I can't take the risk. I'm going to have to buy it at less money because I don't know if it's going to do what you say it's going to do.
So in your model, you set up the creative financing structure, and then you just turn around and you sell the note to an end note buyer.
Yes,
is what you're doing, correct?
Well, I am a note buyer too, but I can't buy everything, right? So it'll either go into our fund short term, and then we'll bundle it together and package it and sell it out. So I'll take, $150,000 notes and sell out a $15 million portfolio, do it that way. Or we'll broker it from the beginning, because when we sell notes, the process is what gets us the value. Underwriting is a big part of that, but so we're vetted as the process has been vetted, and it's been vetted because it's been vetted by a 100-year-old federally chartered bank that said this is a really good process. We bought it, and we just replicated that. Basically, we just modified it. And so now what we do, for example, we used to always do our own creating our own notes. Now we do is show other people how to do it, but help them stay in the deal with the cash flow and the cash now and the cash later, but also help them exit out of the debt side of it so they can get their capital back and redo another deal, right? So that's the value that we provide. So we teach them and show them how to do that. And then we also because that allows us to do more deals, and we are ultimately the buyer on almost 95% of the stuff that goes through the infrastructure that we built.
Because you want to be the bank.
Absolutely. I wish I could be the bank on everything, right? But I learned, and when we created this strategy, because look, this is really important. It took me about 500 notes. I don't know how many notes I've created now. It's probably over 900 now. I don't even know the number. The first 450 to 500 notes that we created, I did them wrong. And I don't mean like I did them wrong. They were really good notes, but the structure was wrong. And that structure cost me about $6 million. And just in structure alone. I didn't like lose $6 million. I lost the opportunity to keep $6 million, right? Because of the discount that I did. Well, that's $6 million of paper value, right? Mm-hmm. You still have, Caleb, you still have that amortization table up?
No, I closed it out.
Okay. I was going to say, well, the number is about 3x. Okay.
So don't do it to yourself, Nick.
It's part of my therapy. It keeps me saying, okay, if I can help one other person not make the same mistake, then I feel like it was worth it. No, I'll never feel like it was worth it. I don't care how many people I help, but that's just the face value, right? The real value potential of earning is about 3x. So $100,000 face value note is really has the potential to be 3x that or $300,000 because of the payments over time and the interest that's collected.
Gotcha.
It's a big number.
Well,
So,
Nick, this has been fascinating, man. And thank you for your time coming on.
absolutely.
Like, how do people get a hold of you? What's a good?
Yeah, so I
That's a
think
good
the
way.
best thing to do is if they go to bethebankblueprint.com, they can get in, they can see some of the stuff that's there. The most benefit that we offer is probably through our private Facebook group, which they can access through Be the Bank Blueprint. So they can go on there, they can get downloads, they can see videos, they can see working examples of what we do. We have a private Facebook group where we do what we call office hours live. My partner Eric Sage and myself, we usually do it once a week, and it's all the creative deal structuring, and we help deals get done. And we have a deal analyzer software that I'll be happy to give out as well. If they go to Be the Bank Blueprint, fill out the information, they'll get a link to download this deal analyzer software that really walks you through how to creatively structure these deals, how to put them together on paper to see if it's a deal or not creatively, because it may not be a deal or not creatively. Just depends on how it's structured, right? But the opportunity is now to really take advantage of this and really put some significant cash flow assets in your portfolio without incurring a lot of risk. It takes a little more work. It's not as easy as a wholesale deal. Like, I will promise you that. But the way I look at it is this: I'm going to get the benefit of this effort for potentially 30 years, right? I can create a note, even a $30,000 note, second note. In that example, the $200,000, $30,000 second note. On a $30,000 second note at 9.75% interest, I can pull the calculator up real quick. It comes out to be probably 260. Let's see what it comes out to be. Let's call it 30,000. 30,000. This is important because 30,000 in 30 years comes out to be $257 a month. Now, I'm not a landlord, but I do know this: $250 a month net as a landlord is a pretty good net amount. Not great, but it's not horrible. It's pretty nice. Most landlords would take $250 a month. Now, what's not in here, guess what I don't have? I don't have any liability. I don't have any responsibility. I don't have any risk. I don't have to fix a roof. Because guess what? Do you have a mortgage? You have a mortgage on your house, Jim, Caleb, either one of you guys?
I do, yeah.
You do, right? Good. How many times have you called the bank?
0.
Why would you call the bank? You call when the toilet breaks, you call the bank?
I got to call a plumber. That's right.
You got to call the plumber. Does the bank give a crap? No pun intended. If your toilet breaks? Probably not. They just care that you make their payment every month. They'll deal with you when you don't.
Yeah, that's right.
It's what they got on you, the golden handcuffs. Because if you decide not to make your mortgage payment and you decide not to do some other thing, sell the house, refinance it, loan mod or whatever, guess what they're going to do? They're going to say, you signed this agreement and we're going to protect our investment. We're going to go through the foreclosure process. We'll give you 20 different options to fix it, but they have the house as collateral, whether you like it or not. Well, same thing in our situation as well. And we want to utilize that. We don't want to take anybody's house. We want to fix the problem. Hopefully we're not going to write a bad note to begin with. But I'm going to get $250 a month, $257 a month without ever taking a phone call from anybody. Because because there's a different mentality when you're a homeowner versus a renter, right? You take care of things better. The roof leaks, don't call the bank, right? Yeah. Don't call them or anything except for a payoff. That's why we do it. And that's why I would much rather take $250 a month in perpetuity for up to 30 years. That's worth 3x and never have to talk to anybody versus making $300 a month or $350 a month. I don't care any number because that's a job. Even if you have a property management company, it's still a job. Because the way I look at it, I'll just go do one more deal, right? I'll just go do one more deal like this, get it structured correctly, and allow me to stay in it because I'm okay doing a little bit more work because I get the benefit of up to 30 years. And if the game is over in 10 years, well, then the game is over in 10 years. But I got 10 years out of that lottery ticket, if you will, that you're not going to get anywhere else. So I get to sleep a lot easier at night, not worrying about my phone ringing and dealing with all this stuff. And there's enough opportunity to just go do more deals, and if you have the ability to acquire, it's a phenomenal strategy because you're already dealing with sellers as it is. You just got to structure it a little bit differently.
That's right. Well, Caleb, any closing thoughts, buddy?
Nothing for me. No, this was great information.
All right. Well,
Why not go out and be the bank, right? Or you already do
absolutely.
Anyway,
Absolutely.
Go join the Facebook group. Listen to Eric and I go through these deals, talking about all the time. Obviously, some areas are better than others. Okay. Some states are better than others for different reasons. Is a state judicial or non-judicial? We were talking earlier, Missouri or Illinois. Hell, they're right next to each other. East St. Louis, they're pretty much suburbs of each other, but it's an entirely different position if you're writing notes and you want to be in the note game, because Missouri, I believe, is non-judicial. Illinois, judicial. Big difference. Missouri, much more pro-bank. Illinois, much more pro-tenant or home owner occupant. Not a problem until it becomes a problem. That's why we really, and you can write these things anywhere. I'm not saying you shouldn't write own or carry in Illinois, but you have to understand if there's going to be an issue, you got to factor that risk into the equation, and that will impact the value of that note.
That's right.
Just the way it is. So all notes are not created equal.
All right. Well, thanks a lot. Appreciate it.
All right, guys.
Thanks
Have a
so
good
much,
one.
Nick.
Take care. We'll see you guys soon.
That's a wrap, guys. For additional resources, go to doorstodeals.com. And don't forget, we're already generating over $186,000 per month in passive income for people in our world. And we're just getting started, and we can help you out as well. So if you want to grow your passive income, we have multiple options available. The first step is for us to get to know each other better. Give us a call or send us over a text message at 314-310-4886 to get started. And finally, go out, live your purpose, and above all else, go after your dreams. Till next time. Thanks for tuning into this show. For more episodes and resources that will unlock doors to deals, check out our website, doorstodeals.com.